Welcome to Startup Success, the podcast for startup founders and investors. Here you'll find stories of success from others in the trenches as they work to scale some of the fastest growing startups in the world. Stories that will help you in your own journey. Startup Success starts now.
Steve, it's so great to see you. Thanks for joining us again.
Thank you. Thanks for having me. Great to see you too.
We love these episodes. They're super popular with our listeners. I can't believe we're wrapping up Q2.
I know.
Can you?
It was just the holidays. My God.
I
know. Same here. It's like, wait, what? Hold on.
I know. Time is flying. It's July 1st for everybody listening when we're recording this, which is insane. So tell us, what was your take on Q2?
Q2. So, I think the broad messaging there is we had a lot going on in Q2, a lot of cross currents. We still have some sort of like a hangover on them, but it seems at least like there's a viable pathway to the conflict in the Middle East, at least simmering down a little bit. I don't know if we're going to get to the sort of peace in our time kind of thing that a lot of folks are talking about, but it does seem to be on its way toward at least a less impactful situation there, where we were getting whipsawed, literally every day. The Iranians have agreed to this peace, and then the Iranians are like, no, we didn't. So I feel like that's going to help keep the volatility down, both in the news cycle and in the markets, which is great for what we do and for founders out there trying to build a business and stop getting, distracted from all of the thrash that's out there. That's a good thing.
That's a great thing. That leads me to something. We had a question come in from a listener for you, and it kind of relates to what you just said. It was a founder, and the founder, he asked, does the stock market impact VC cycles?
Oh, that's a great question.
I know.
Yes, it does, but it isn't as linear as you would think. So what you have to think about is the stock market is a discounting mechanism. It is trying to price today what it thinks is going to happen down the road. That's why things like interest rates and inflation and bond yields and all that sort of stuff is dollar, right? That's all very important because it impacts corporate profits down the road. The stock market's not pricing what happened last week. It's pricing what it thinks is going to happen at the end of this year. Okay, so it brings a lot of valuation forward. VC is a cyclical industry. So that means it's very prone to big, wide, like swoops and dives around primarily the cost of capital, because VC competes with other markets for investor capital. Let's just be honest, right? So when bond yields are really high and recession is looming, LPs and VC funds tend to pull in their horns, and vice versa. When we had zero interest rates a few years ago, capital was free, money was flooding into the VC ecosystem, right? So it is now. It's a very cyclical, much more cyclical than the broader stock market. There are sectors within the stock market, like industrials, that are also very cyclical, but broadly, the VC market is more cyclical than the equity market. Now, where they do intersect, though, is returns, right? And, everybody just saw the SpaceX IPO, right? That was a gigantic return for the VCs that were involved in that. So when the VC exit pathway is IPOs, which is very often the dream outcome, right? That is very much a function of the stock market's broad sort of like mood. When IPOs are doing really, really well, VCs are doing very, very well too, because the returns are there. When the IPO market is dead on its feet, like it was the last couple of years, then VC doesn't really have the exit mechanism for the LPs to realize returns on their investment, and it gets harder. So they are tied together in that sense through the exit ability. The last thing I'll say too is they are also tied together in terms of valuation. So when VC sees a sector or public companies valued with a certain premium in the equity market, then they tend to want to see that same premium reflected in VC fundraising valuations. So there's a connection there as well.
Okay, that makes a lot of sense. And I think that's helpful. So founders shouldn't feel like if there's a bad day on the stock market, that's going to then impact their round, their pitch next week.
Not in isolation. If the stock market entered a 6-month bear market,
right,
then yeah, you're going to feel that pressuring your fundraising valuation because everybody looks at that and it just creates a vibe over the entire question. But one bad day because, you know, I don't know,
Right.
Anthropic sneezed or,
Or
something
like what we're
happened.
talking about, Iran bombed
Exactly.
something.
No,
Yeah.
that broadly, one incident like that will not tend to flow through.
Okay. And then I think you brought up a really good point about IPOs. For a while there were so many IPOs, successful, huge, you know, they
Oh,
came
yeah.
out
And there's more
really
coming,
strong. Yeah.
right? So
And
we
then
had SpaceX, a
yeah,
trillion, right?
right. And then, but before that, we didn't have any for a while. But now we
Right.
had SpaceX and we had more coming. Well, how will that play a role in,
Yeah.
the health
It's
of the
really important.
VC? Yeah.
I think something that we haven't talked about a lot here, and I think a lot of founders don't really have front of mind, is what we used to call the power law of VC, right? And the power law, for everybody who doesn't know what I'm talking about, the power law is basically the theory that a VC fund is going to go write checks into 100 different companies, fully knowing that 98 of them are not going to work, but two of them are going to give them 100x returns. Okay. What we just saw with SpaceX is the power law on display, right?
Yes.
So there's $1 trillion IPO, right?
Right.
We have OpenAI coming. We have Anthropic coming, also
Hmm.
$1 trillion
Hmm.
IPOs, right? So liquidity is broadly kind of been metered lately. It hasn't really been that available. And then all of a sudden we get these three, right? These three IPOs, if they happen this year, will create more value, okay, than all of the VC-backed IPOs this century,
Wow.
right? So
Wow. What a
pause on that for a
stat.
minute. What a stat, right? So a lot of news and a lot of thrash around the fear that that will drain liquidity. But for what we're talking about, it's actually providing liquidity. Those yields, those returns that are going to go back to the VCs that back these three companies are going to dwarf the entire AUM under whole firms under management, right? So AUM is assets under management of
Hmm.
whole companies, whole VCs that are out there. That will get recycled into startups. The other thing that it does is, you see A16Z with, a $15 billion fund, right? They have already made 75 investments through the end of May, right? If you add General Catalyst and Khosla and a couple others, they have another 100 and some odd, right? So
Hmm.
just A16Z alone, they're writing 2 checks a week. What
Wow.
they're doing is because of that power law, which we're now seeing actually unlocking
Hmm.
returns for them, they are going to put as much capital at work as early in the VC cycle as they can, the funding,
Hmm.
seed A, B,
Hmm.
so that that power law can be as widely distributed as humanly possible. So we are sort of seeing finally this cycle. I didn't think it was going to be concentrated in three IPOs, but we are now finally getting to a place where that wheel is starting to turn around again, which is great. For founders listening here, you do have very large VCs that have a lot of capital that they are putting to work in primarily seed and Series A startups. Now,
That is great news for
AI
founders.
is still the story, though. So we haven't gotten entirely out of the jam we've been talking about for the last
Right.
several calls because it is still heavily an AI story. But I'm going to stick to my prediction that that will spill over. There's a rising tide lifts all boats here a little bit, and I do think we're going to see it across the board in the back half of this year.
Good. Okay, that's good news for other startups and other sectors.
Well, we're already seeing it.
Are you?
First, yeah, you're starting to see like some of the statistics coming out of Crunchbase and PitchBook is that this year is on track to be either close or a record year in first financings for startups. Okay, now they're being very deliberate in how they describe that because they're not declaring it by stage, and the reason they're doing that is, I mean, we were talking to a company last week that just did a $30 million seed
Wow, that's
that
incredible.
didn't used to happen, right? Like
No.
that.
That,
So, but it's the first institutional capital going into these startups. So if you look at it on that basis, we may end up having 6 or 7 thousand of them this year if things stay on track, which would be a record. So the money is beginning to move, and we just, we got to keep our fingers crossed that it continues.
Okay, excellent. What about the smaller VC firms? Are they writing checks and
I
moving
think they're
money
trying
into?
to.
Okay.
The AI is still the story, though, creates kind of like this giant like vacuum in the marketplace where
Mm-hmm.
the really large firms that have a lot of name cred and a lot of, sort of like market ability to move things, they're taking up a lot of the really hot rounds. And that's not leaving a ton of room for people to get in on the edges. The other thing I'll say is that fresh LP capital is going almost exclusively to the top 5 or 10 VCs. So smaller funds are having a hard time raising additional capital right now. Now, I do think that starts to unlock if what we're talking about continues to happen, but for right now, it's pretty hard. Um, this is at the upper echelons, a pretty clubby thing. So people like to invest along people they know. Um,
Mm-hmm.
and that tends to shut out a lot of folks that would otherwise have been involved. But when you're doing, I mean, I have it here. Hold on. Did Anthropic just closed a round?
Mm-hmm.
Um, I can't get it quickly at some incredibly high valuation, right?
I
And the
saw
reason
that.
they're able to do that is because they've got 5 or 6 people on speed dial that they call and they're like, well, yeah, of course, because they're in the
Right.
same boat. But when most of the new funding is going to the top 5 VCs, it tends to crowd out, frankly, a lot of the other ones.
But you said you feel like that will unlock if
I
things
do.
continue to move in this
Yeah,
direction.
because the sort of like reverse liquidity that we're talking about will begin to flow outward. The other thing to call out is that what it does do for everything but the hottest AI, whatever, is open up a bunch of space for kind of everyone else, right? Like a good example is potentially the biotech space, right?
Mm-hmm.
None of these firms, unless they have an AI application, are really looking closely or heavily, at least not getting a lot of the headlines. So what that does is mean, okay, that means this capital is not chasing the next cure for cancer. So that might open up a lot of space for VCs that do focus on that to have a piece of those rounds, right?
Okay,
So
that makes
to the
sense.
founders, like don't think you're going to just toss your deck into the fray over at A16Z unless you've already probably had some of those conversations. But in terms of the specialist funds that are really focused on your particular niche, it's probably pretty open. So that's a thread to spin as well.
Okay, good, good. And what about, so that's pretty positive. What about the economy as a whole?
It's really fascinating, right? Because there's an old saying that like markets climb walls of worry. And so while we're all wringing our hands around the war in Iran and inflation, and you're actually seeing the underlying economic data chugging along. The one thing I worry a lot about is consumer spending. I watch
Right,
interest rates pretty closely. We've been on this podcast several times talking about interest rate cuts. Frankly, I think they're sort of out of the window as long as inflation remains elevated. And inflation is elevated. The
right.
key factor there, though, is we kind of all know why, right? So the Fed is going to be watching very closely to see whether the higher inflation that we're beginning to feel is systemic in nature or more episodic because of the spike in gas and some of the other follow-throughs that we saw from the conflict in the Middle East. So now you're kind of in this jam where the Fed is like looking at this whole thing. We also have a new Fed governor who is
Right.
handpicked by somebody who is addicted to lower interest rates.
Yes.
So we're going to see what happens. They're going to be in a bit of a pickle, I think, going into the back half of the year. But I'm personally kind of no longer expecting a lot of cuts. We might get a token one. I don't know, maybe around the midterms, just
I
to
feel
put
like
a
there's got to be a lot of pressure, right? To do.
tons, right? Even if it's a quarter point, it would put a stamp on sort of the tenure of the Fed. But I wouldn't expect, and I think it's important for founders not to expect what we were sort of thinking might happen in the last, 2 or 3 calls ago, where we might get a strategy of lower interest rates,
Right.
2, 3, 4, 5
Mm-hmm.
cuts over a 12 or 18-month period. I think that's out the window.
It's too
Maybe we
bad.
get one. That said, though, um, they're able to do that because I think they kind of know inflation's probably capped. because
Okay.
we know why it's happening.
Right.
And the economy continues to kind of show this incredible underlying resilience. So as long as those two things are in place, I don't think we're going to need to see interest rate hikes. We may see a little bit of a cut. And I think the important thing for founders is, as long as the economy is chugging along, startups are being founded, people are working on really cool stuff, there's
Mm-hmm.
money to put at work, right? The whole side of
Mm-hmm.
cycle that we talked about earlier is still intact.
That's a great message, and I hope people listening hold on
And
to
I
that.
and I hope I'm right.
Yeah, I do too.
But remember, can I
Let's,
throw one more thing in there?
of
Remember
course.
to, for the founders out there that are not macroeconomically like interested or a lot of experience with it, interest rate cuts and interest rate hikes, interest rate moves need 12 to 18 months to percolate their way through the economy. So even if the Fed cut interest rates today, for a founder out there trying to build a startup, it's not really going to be visible, or you're not going to feel it. You're going to read a lot about it, but you're not going to really feel it for a year. So it isn't, it's not, I don't want to say it's not important. Of course it's important, but it isn't going to be felt by any startup listening to this, even if it did happen. So be focused on your startup and the funding and running and building your company. The macroeconomic backdrop is super important and it plays a big role in this stuff, but it's not a tactical influence on your company, really, right? It needs a while to percolate through the economy. Even if we get a token cut in the fall, it doesn't really change the ground truth for your startup. Not yet. Okay.
I'm glad you noted that again because we all forget that at times. Because the world's moving so fast, so
Right.
you just forget that
Right.
there's
Right.
that time. We're wrapping up here. Thank you again for joining us. You've mentioned on previous shows that founders should just keep, due diligence, get their metrics in place, keep their focus on their company, not get too distracted. Anything
Right.
else you want to add as we go into the second half of the year?
Um, I mean, that's pretty good advice. I want to maybe reiterate or reinforce the value of having kind of your ducks in a row. Like if we're right on that capital beginning to work
Mm-hmm.
its way outward into more deals and more VCs and more startups, it's more likely that some of this begins to happen at a faster clip.
Mm.
So, unless you're in this very favored sector, which a lot of our startups are, so great, you may go from term sheet to close in 3 weeks. But for everybody else, the the time to make sure you've got everything figured out, your financials are in shape, your hiring plan is in place, your
Mm-hmm.
budget's done, your accounting's squared away, is not when all of this money starts to unlock, if we're right, right? It's actually before that. So I just want to reiterate again, whether it's with us or somebody else or yourself, just make sure you're ready. Because if you're not ready and I'm right and that capital begins to move, there's going to be a lot of hands in the air for that money. And so you want to make sure that you're able to respond quickly, when the call comes, because it's not going to happen probably again. Like a VC reaches out to you and, hey, are you guys looking to raise money? Yes, we are, but gosh, we haven't balanced our books in 6 months. They're they're
Yeah,
gone, right?
they
They're not
moved
going to wait
on.
for you. Exactly.
No.
So just be sure you're ready. And there's tons and tons of information out there on how to become ready, from us and from everybody else. So just be aware of it, read it. Then I think the other thing I will say is don't get too distracted. It's so easy,
So
right?
easy.
So easy. And part of that distraction is don't think AI is going to raise the money for you, right? We are already seeing, I met with some of the A16s guys last week, they can spot a deck made by Claude.
Really?
Yes.
I could see that because in marketing, I can spot something written by Claude.
Right.
So, yeah,
So,
so that makes sense. Good point. I'm
maybe
glad you
use it
brought
as
that
a
up.
shell, but it's not
Yeah.
a cheat code for fundraising. Okay. Everybody, like, don't think it's a hack. It isn't.
Wow.
And if
Okay.
anything, it'll work against you because they'll sense a founder trying to shortcut probably
Right.
one of the most conversations you're going to have in your company's gestation. So maybe a tool, maybe as a way to
Yeah.
kind of like a place to think from, but don't just create a deck and ship it off to the partner at the VC firm you're speaking to, because it might actually hurt you, right?
I'm so glad you brought that up. What a great point. Yeah.
And we're seeing it. We even see it on our end when we're asking questions from a CFO perspective, and we get an AI reply, and we're like, no, 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 no. We need you to answer this
Yes.
stuff, not Claude. Like Claude's great, but it's not you, right?
Exactly. Yep. The pendulum is finding the right place for
Exactly.
AI use. Yep.
VCs at an early stage invest in people, right? Everybody
Yes.
remember that. They are investing in you
Yes.
as the founder.
That
Everything
is
else is just
so
part of the story.
true. Steve, that is said by every VC on this show
That's right.
over and over again. We are investing in the founder and that first team.
That's right. So if you
That,
created your
yeah.
pitch deck using Claude, what does that
What does
tell
that
the
say?
VC,
Yeah.
right? So
Yeah.
like I said, use it
Excellent
as a
point.
tool, but it
Yep.
should still be you communicating and crafting and telling that story. Because honestly, no AI is going to tell the story like you, because you're the
Right.
founder, right? You
Right.
have the idea, you've got the passion, you've got the, you know, skills, the experience,
Yep.
whatever it is that led you to found this business because you
Mm-hmm.
see a need in the marketplace and you want to go fulfill it, right? Claude can't replicate that. So
Never, never.
just keep it in
So
mind.
true. Great advice to conclude the show. Always love chatting with you.
Yeah, me too. These are fun.
Crazy to say, I will see you in the fall, or
That's
we'll
right.
be back
Great.
then. All
Awesome.
right. Thank you, Steve.
Thanks for having me. Cheers.